and thank you for joining our webinar today. M&A Negotiations, Are You as Good as You Could Be? By Brian Moriarty, who heads his own outsourced corporate development consultancy. My name is John Badger, co-founder and vice president of marketing and product here at ShareVault. Today's webinar is number 27 in the ShareVault webinar series, and it's our 8th webinar specifically on the topic of M&A best practices. I'm going to give a very brief intro before Brian gives his presentation. Following the presentation, we'll give a short demo of ShareVault, and then we'll get into an interactive Q&A session. Before we get started, just a few logistical details. The complete duration of the webinar will depend on the number of questions, but we'll wrap up in less than an hour. Your individual audio is muted due to the size of our audience today, so please type questions into the GoToWebinar question box as they arise. This webinar is being recorded and will be sent to all attendees soon after the presentation. And of course, we want to hear from you. Please let us know how you liked the webinar today, and feel free to request topics for future webinars. Today's webinar is hosted by ShareVault, a leading virtual data room provider that allows for simple and secure sharing of sensitive documents in the cloud, with broad business applications, including the distribution of due diligence documents for M&A, partnering, licensing, investor communications, and many other secure document sharing applications. The presenter today is Brian Moriarty, a longtime friend of the company and also a personal friend of mine. He also provides outsourced corporate development services, including both M&A and integration services, to mid-market companies. He's a mentor for startups at StartX, the accelerator program at Stanford University. Over his long career in investment banking and corporate development, Brian has negotiated transactions ranging in size from very small to multi-billion dollars and totaling over $50 billion in transaction volume. Brian has closed virtually all types of business combinations, including mergers, acquisitions, divestitures, joint ventures, venture investing, minority stakes, licensing, and strategic alliance relationships. In addition to his deal-making experience, he's led and participated in over a dozen successful integrations. Prior to starting his consulting business, Brian was a vice president at Hewlett-Packard, where he led the HR group responsible for both M&A and outsourcing. Brian also supported HP's pending separation into 2 publicly traded companies, HP Enterprise and HP Inc. In fact, this is the largest such separation in history. And prior to HP, Brian was VP of M&A at Sun Microsystems, where he was responsible for 20 transactions totaling $20 billion. He also led the Associated Integration Group and was a member of the team involved in the sale of Sun to Oracle Corporation. Our previous webinar topics have focused on various best practices related to preparing for an M&A transaction. Today's presentation is completely focused on M&A negotiation and how academic research can help improving negotiation outcomes. Brian will take you through typical M&A negotiation scenarios and ask you, the audience, for how you would handle each scenario. Just click to enter your answer when prompted, and we'll be displaying the polling results on screen as he steps through each scenario. And of course, Brian will explain how the choices are supported by academic research and his own experience. So let's get started. Brian.
John, thanks a lot. I really appreciate the opportunity to talk to your clients and our friends. Certainly I've been a supporter of ShareVault for quite some time. And thank you for the introduction as well. I really appreciate it. What I'd like to get started with is, I can just talk for a second about how my interest in negotiations got started, especially with an academic background, because I think it's kind of interesting. When I was in business school years ago, I had to take an organizational behavior class. Now, at the time, I was focused on finance, I was focused on strategy, kind of in accounting, kind of the what I consider to be more the blocking and tackling subjects of business school, and organization behavior was was just something you had to take. So I didn't quite get why I had to take it, but I did. It turns out that my professor was an expert at researching negotiations, and because she loved the subject, we spent at least half the class talking about that. And so I kept that in mind throughout when I went to investment banking afterwards, And as I witnessed negotiations and then eventually started participating and leading in negotiations, what I found was that a lot of the stuff that I learned in business school, people just did not apply well in real-world situations, which surprised me because you would think for these large deals that have so much on the line that people would use academic best practices, but it's just not always the case. And so I've always been interested in the subject. I'm so glad to talk to you guys about this today. And in fact, as I was preparing for this discussion, I did review one of the books from that professor that I had at Kellogg. Her name is Margaret Neal, and she's now a professor at Stanford. At the end of the presentation, I'll show you what I think is one of her best books to kind of best understand negotiation theory, because I think it stands out as something that should really be a must-read for people. Also, if you ever get the opportunity to hear her in person, because she does do public speaking and engagements, it's really a treat to do so. Okay, should we go to the slide, John? Are we all set? Okay, great. So just getting started, in negotiations, everybody does it, right? We certainly do it in an M&A context, but we do it almost every day in life, whether we're negotiating with kids, who tend to be wonderful negotiators, with our spouses, you name it, we're negotiating in one way, shape, or form. Many people I know, in fact, I'd say most people I know, believe they're at least proficient negotiators. Most business people I know say they're good negotiators, and some say they're great negotiators. What I found, though, is it's very hard to measure how good a negotiator you are because there's no control group. You go through a negotiation, either you get what you want, or perhaps you didn't, or you end up at a spot that you wanted to end up at, but did you really get as much as you could, depending on how you played your cards, essentially? So it's a self-assessment. It's just hard to measure. What I've also found is that many people think of negotiations as a negotiator as having innate skills. In other words, something you're either born with or you're not. And I think there's an element of truth to that, but I also think that we can all improve our negotiating skills both by experience, which can be really expensive in an M&A context, of course, but also by looking at academic research. And so what we're going to do today is talk about some of these best practices, and also so we can have the opportunity to sort of learn from the experts in terms of what are the best approaches. I'm going to give 3 caveats before we get started. First, I'm saying best practices. I'm not saying dogma, right? And so this is not these rules are not applicable to every single situation because all situations are unique. What I can say is when these are guiding principles, they're best practices. So I'd invite you to consider them when you're in these situations. Also, some situations that we'll discuss do have legal and regulatory constraints. And so, take these with a grain of salt also. They're not completely applicable to every single M&A situation by any means. And the scenario that we're going to discuss is really more set up for a private company. And so the common scenario that we're going to use, and I've set this up in terms of questions and then some polling, so you guys will have the opportunity to participate, and then kind of talking about how academic research might guide us to the right solution. The common scenario is you're a startup CEO, obviously private, prospective buyers contacted you, and you're responding to questions, and you're about to approach negotiations. And so the first question is, how much do you prepare? And there's here's the responses you have. I like to wing it. I'll research their business on the web and through some contacts. I'll do all that, plus I'll question my counterpart. C, plus I'll evaluate my issues and preferences. And then the last one, kind of all of the above, plus I'll discuss with my colleagues who know the counterpart well. So I believe the polling's open, and I would invite you to please vote on that.
Okay, we're at 75% now, so we're going to go ahead and close the poll. We actually got to 77%. You can see the results here.
So nobody likes to wing it. That's that was not one of the correct answers, so I applaud you for that. It looks like the weight is kind of get all the information you can, including discussing with the colleagues. The next best answer being I'll evaluate my issues and preferences plus kind of all of the above. I can definitely see how people would be drawn to D, kind of I'll get all that plus I'll ask people within my company who know them. And these are shades of gray. What I would suggest to you, though, is that going the extra length of asking people in your company about the counterpart could tip you away from keeping the transaction confidential, right? Because the last thing you want is for the wide assortment of your employees to know that you're actually in negotiations and kind of with who, because that can be destabilizing at the early parts of a negotiation. But I can see how people would gravitate that. From a research perspective, the correct answer is kind of that fourth one. I'll evaluate kind of all of that, plus I'll evaluate my issues and preferences. Now, the theory behind this is really prepare for negotiations. And there's a couple of different things that you have to do in order to best prepare for negotiations. One is you have to know why you're valuable to the buyer, what's attractive about you to them, and what they plan to do with you. And so it's not enough to say, well, they're going to take my product and fit it into their channel and be able to recognize revenue synergies or whatever that's a common rationale, but that's not sufficient detail. The question is really, how are they going to do it? How are they going to integrate my people? What's their high level of integration plan? What's my role? Knowing as much as you can about their plans and intentions can really help inform how you're going to position yourself for negotiations, because that helps you anticipate what their positions are and what's important to them. One of the real common points that gets negotiated with startups, price is will always be the most important issue in almost all M&A situations. But beyond that, how long does the CEO or founder have to stay with the acquired company? What's going to be the role? Those are issues that you really want to kind of understand their position on preferably before you take a position. Know the issues and what positions you want. In other words, research, look at yourself and say, well, how valuable is my company? What's my aspiration price if we're talking about value? What's the most, what price would make me really happy at one end? And at the other end, look at yourself and say, what's the best deal I can do before, or actually, what's the minimum price I can take before I would have to go to another alternative, which might be raising a venture round, which might be waiting a few years to do this again and trying to grow the business, whatever your best alternative to a negotiated agreement is, right? And so when you do that for yourself, do that same estimation for the buyer and look for where there's overlap. And so what we call it is a BATNA, that best alternative to a negotiated agreement. And then where you estimate that for the counterparty, and where they overlap is the zone of potential agreement, right? And so hopefully there is some overlap, and there's a deal that can be struck. But rigorously looking at what you want, rigorously looking at what the other side wants, knowing the other side, all of this is great preparation for negotiation. What some people will say, and I've kind of used this as a rule too, if you're preparing for an hour-long negotiation, spend 8 to 10 hours planning for it, right? Doing this research, thinking about it yourself. It has to be that level of rigor so that you're best prepared when you get into the room. Okay, can we move on to the next one, John? Sure. Terrific. So, kind of the follow-on question that you get all the time is, so, okay, do I make the first offer? And we have 4 different choices here. First one is no. Why limit what they can come up with? Second one is yes, but only if I'm asked to provide it. Third, yes, and I'm going to do that proactively. I'm going to do it before they even ask me. I'm going to tell them what I think we're worth, what I'm expecting. And then yes, and then in addition to that, give them your position on all material terms. Okay, is the polling open, John?
Polling is open. Looks like people are getting the hang of it because we're already up to 25%. We're at 64%. So it's stayed at 64%, so I'm going to go ahead and cap it at that and share the results.
Okay, terrific. So it looks like the 2 at the lead here are the first one, no, let the other party come up with an offer first, or yes, but only if they ask me what they think I'm what I think I'm worth. So I won't volunteer it, but if I'm asked, I'll respond to it. And then some people also, and then the rest are kind of evenly split. So this is a really interesting poll result. What you'll find is, let's go to the answer page, John. What we find is that this really touches on a concept called anchoring. And what anchoring does is it establishes a reference point for negotiation so that subsequent positions are adjusted in respect of the anchor. And so I'm going to give you an anecdote about this where I've seen anchoring work numerous times, and it's insidious. People don't necessarily even know they're being affected by an anchor, but I guarantee you oftentimes and most times people are being affected by the anchor. So let me give you an example. One company I was working with desperately wanted to buy another company. The CEO of the potentially selling organization, for at least a year and a half, told us, my company is $1 billion company. It's $1 billion company. It's $1 billion company. Now, I can tell you, I've done a lot of valuations. I'm sure a lot of people on this call have too. There's almost no way you could justify $1 billion for this company from any rational means. But he kept saying, we're $1 billion company. We're $1 billion company. It was an attractive asset. It was growing. It was profitable, but it was, again, not worth it from almost any rational perspective. Finally, they said, look, we've been approached by someone else. And so we are going to sell the company. We're $1 billion company. We're not happy with the other person's offer. What do you guys want to do? And so my CEO, who was in love with this company, basically came to us and said, we're going to pay $1 billion for it because that's what they want. That's what they've told us they want, and I don't want to argue about price. So would I have come up with $1 billion? Of course not. It would have been something drastically lower. That anchor that the selling CEO set for over a year dramatically affected our view of the value of the company, or at least the value that my CEO saw in the company. Okay? So anchors can be super, super powerful. Also, what I've noticed is in different circumstances, what we find is that corporate development people will ask companies that they want to buy after some research and whatnot, well, how much are you expecting? What do you think you're worth? And then the counterparty will tell them something. Usually, obviously it's kind of the cap of value. You're never going to, if you hear that as a corp dev guy, you're never going to pay more than that, and chances are you're going to pay less. But what I found that did was it impacted the thinking of the buyer organization. Once in a while, the buyer would say, God, that guy's so out off to the moon, we're never going to get there, let's just stop discussions. Once in a while. But usually what happened was, it was like, I'm just going to make up numbers for a second. Gosh, they told us 100, our discounted cash flow and comparables analysis is telling us 60. But there is some strategic worth here, so let's offer 70, because that's like 30 off of what they want. Maybe they'll take it. But what that logic tells you is you were anchored in that 100, and you're responding off of that 100. So anchoring is a really important concept here. Now, let me kind of address a question that you get all the time. What about A? When is it better to let somebody else come up with the offer? Because who wants to limit what value someone is going to come up with? And I will say, and academic research supports this too, in some cases, that's a better path. And those cases are when the value of your company it has a really wide range, and you cannot really well interpret what the other company is going to do with you and how they're going to value you. And so you find this most often in hot, let's say, internet companies especially, where the revenue is really small, the profits are non-existent, it's a small team, but they have a huge level of adoption. For instance, like WhatsApp with Facebook, for instance. And it's probably a good example of that. Who knows what the true value is of that? We know what Facebook eventually paid for it, which has been commented in the press as a pretty high value. But would WhatsApp have asked for that? I don't know. I don't know if I don't even know if I could have asked for a price that high.
What was that? It was $1 billion, right?
I think it was 17 billion.
17 billion.
Yeah, it was massive. So in other words, there are times when it's very difficult to assess the value of your company because it's so early stage, it's in a really hot space, it has huge adoption, but you can't look at value through financials. In that case, it might be worth considering letting the other party make an offer for you. Now, the downside of that is they could come back with an offer that's so low, you get anchored, even though you know you shouldn't be, but you will be. And then you're responding off of their playing field. So there are trade-offs here, but there are times when that first one, don't limit what they can come up with, just let them offer something, is the right course of action. Okay, should we move on? And then, so you've kind of taken this advice, you're in the position where you're going to make that first offer, or at least you're going to talk to them about the first offer. So the question is, how aggressive should you be? Should you keep it simple? Just tell them what you want and expect that they're going to meet you, like my CEO did. Maybe give some wiggle room, maybe 10% more than you want because you hate to negotiate. Propose a rational figure based on objective criteria that's obviously higher than what you would live with. And then the last one, give an offer that is just this side of crazy, that is super aggressive, but can't quite be characterized as crazy. Okay, so are we polling?
Still ramping up.
Great.
Okay, we'll cap it off here at 72% voted.
All right, terrific. So, I think everybody knows not to just propose what you want on the first go around, right? So keeping it simple rarely is the way to go. Some people think that just a little bit above because you hate to negotiate. That's a strategy. It's likely not a strategy that's going to lead to the best outcome for you. The lion's share of people, 71%, think that propose a rational figure based on objective criteria. That is a really tempting answer, isn't it? Because if you want to be able to justify it, you're going to get into a fight about it, give something that is based on objective criteria. And then some people kind of chose that last answer, just this side of crazy. Now, the right answer, according to academic research, is just this side of crazy, right? So 24% of the people got it right. Now, what do we mean by that? What we mean is that this is your opportunity to set an anchor. You want to strike a price and an offer or a bid, I guess, for the company that is so high that it's going to definitely get you what you want, is going to set an anchor with the company, but it's not going to be so crazy that they're just going to completely dismiss it or just walk away. Because both of those are bad scenarios if you're trying to get a deal done. So it's a fine balance, but if we think about it back in that framework of what's the counterparty's best alternative to a negotiated outcome, right? You want to come in, right around where you think their absolute limit is. Now, you also want to be able to justify it. We're going to talk about that in a second too. But you want to come up with a pretty aggressive price. So, for instance, we talked about that billion-dollar company scenario. That's an important anecdote to keep in mind. I'll give you another anecdote, though, that will help kind of curtail the enthusiasm we have for offering up giant prices if you're the seller. And it's a situation I encountered that I kind of think of as the non-callback. I was with a company. We made an offer for a startup, and I thought it was an okay offer. It certainly wasn't fabulous, but it was okay. A couple days went by, a week went by, nothing, no response whatsoever. So I called the guy back, the CEO, and what he said was, I didn't think you guys were serious. I think it was so low that it didn't even really occur to me to counter. So he's playing a risky gambit, right? Because I could just walk away at that point. I did the natural thing was, well, what do you think your company's worth? What are your expectations? Because what you want to do is you need that counteroffer so you can start a process or start discussions. But he wouldn't do it. He wouldn't give me a counteroffer. He just said, look, I think you guys are really low. So I had to go back, talk to my people, and then rebid and come up with a different value. Because frankly, it was either that or postpone the deal for 6 months or a year and try to come back to it, which as a large corporation, when you want to do a small private deal, you want to do it then. You don't really have your people aren't really willing to wait around for 6 or 12 months. Either you do it or you don't, and you execute Plan B. So that's kind of the curtailment of enthusiasm approach, kind of what's on the other hand, the no callback situation. You want to suggest a price that is just this side of crazy, right? That is aggressive, but that's going to get you that callback, but that's going to get you that counter offer. All right. Next question is, how do you make that offer? Do you verbally provide a price range? Do you verbally provide a point value? Do you provide a point value in writing with some support? Do you do all of that plus you provide some supporting analysis? Or do you do all of the above plus your position on key non-monetary issues?
Votes are coming in a good clip.
While folks are voting, that expression, just this side of crazy, was actually used pretty frequently in one of the books that I'll cite at the end in terms of what you want to strive for. It's a funny phrase because it sounds so irrational in business, but actually that was in the academic best practices. I thought that was kind of interesting. So how are we looking at participation for this one?
Yeah, there's still votes coming in actively, so we're going to let that keep coming in.
A little percolation.
Yep.
All right, so we're kind of evenly split in the first three. Provide a price range, provide a point value in writing with some support, are kind of those. So it's pretty evenly split between those first three. And so what we find is that the best is kind of one that people didn't really pick so much, and which is provide the full support plus your rationale and position on key non-monetary issues. Now, I agree. This is very circumstance specific, right? But let's talk about what the negotiating concepts are here behind this. What the research has found is that if the more precise you are, and the more objective criteria you can use to support your analysis, the more seriously and the more impactful your position will be with the counterpart. And so if you give them a price range, if you say we're expecting $50 to $60 million, the counterparty sort of struggles with that, right? It's like, well, okay, well, if I'm the buyer, I hear 50, they're telling me 60, that's sort of the bid and ask. Okay, that's what their view is, right? But it'll be kind of discounted because it's not precise. It's like you really haven't thought through this as much as you could. So you can provide a point value verbally. Now, and a point value, in my opinion, is generally better than a price range. But the point value verbally doesn't convey that serious intent that you have the opportunity to convey if you can do so in writing. The supporting analysis gives you the objective criteria that supports your position, which gives your analysis and your position a little more gravitas. So best practices will tell you that that's generally the way that you would want to go. Now, in M&A negotiations, this isn't always the way it works out. I can completely hear that. But oftentimes what you also want to do is include and loop in key non-monetary issues. In a startup situation like this, oftentimes it's, are you going to come work for the buyer, right? And for how long? So it depends on the situation, but oftentimes there are key non-monetary positions that you want to get on the table as well, so that you can loop it into a whole discussion. Again, I will say that it's fact and circumstances. That's not always the right way to go, but I'd ask you to consider it if that's an opportunity for you, because the bigger the pie, generally the better you can do in terms of negotiating. Now, one anecdote I'll give you is a negotiation I did not participate in, but I did talk to people who did. It was a big web company. They were desperately attracted to a target company, and one of their key competitors was attracted to them also. So this prospective buyer knew the seller, had dinner with them. Over dinner said, okay, we want to make an offer for your company. We have a letter giving out the value and our rationale. Here it is. And the CEO of the target company of the seller said, no, don't give me a letter. Just tell me what you want, or just tell me what you think the price is, and we'll consider it. And so the team said, okay, fine, we'll do that. And so they verbally conveyed the price range. Dinner concluded. About 2 weeks later, and after some conversations, just like, well, we're mulling it over. About 2 weeks later, they got the call that the deal had traded away from them, and that they had already signed a contract with another party. So one of the things that they could have done was, as they're walking into dinner, push the send button on an email that has the letter, right, and get that letter in the hands of the target company CEO. Now, why is that important? Because A, it conveys serious intent, but B, there are multiple parties who are considering an offer on the other side. And something in writing is much, much, much more likely to get passed around and thought of amongst the board and the company, and not to mention the CEO, than is a verbal offer over dinner. I'll give you another example too of something that I thought was pretty interesting. We were negotiating against a very prominent technology banker several years ago, and the strategy he would use was, when they were going to make an offer, they'd schedule a call, and literally 2 minutes before the call, the email would hit with the letter. And so what he was doing was, he was not allowing us to say, hey, look, don't give us the letter. Your offer's too low. Don't give us a letter. It's like, well, sorry, it's already sent, right? So you got to do something with it at that point. But we also didn't have time to look at it and then say, we're so far off, let's not even have a call. So that tactic worked pretty well. Okay, let's move on to the next question. And I think this is the last question. The question is, so you've received the first offer, how do you react? Do you show a lot of indignation? You're so low, you're wasting my time. Do you ask clarifying questions? Do you express disappointment and say, we have a lot of work to do? Do you immediately make a counterproposal? Or do you pause and conclude the meeting and so you have time to consider and then reconvene? Okay, so are the polls going?
Yeah, we've got a good flow coming in. Still clicking along, so we'll let that go. Almost no drop-off on this webinar. Sometimes you have people drop off as the webinar goes on, and it's virtually nil. So, Brian, you must be doing something right.
Always glad to hear that. Good for the feedback. Thanks.
This is the first webinar where we've done this degree of audience input. Okay, we got up to 70%. I'll go ahead and close this poll so Brian can keep going.
Yeah, sure. And so it looks like the two top answers are ask clarifying questions, which is in the lead, and pause or conclude the meeting to consider. Frankly, I think both of those are fine strategies. I've had people respond in all of these categories, including one person who looked visibly ill and had to use the restroom before responding, claiming that they had to, so which I guess is the negative one on this scale. But let's go to the answers, John. Okay. So what I'll say is, first, this question is sort of culturally specific, because there are different cultures where some of these answers will be more appropriate. But what the research will find is that you want to be able to use what you learn in negotiating when it's your turn to offer something up. And so most people need time to digest something and then kind of come back, right? Now, I think there's a lot of good answers in here. I think asking clarifying questions is fine. What asking clarifying questions does, though, is in some ways it validates the other party's position, right? Because then you're already starting to respond to it, and frankly, you're already starting to anchor yourself to it as well. What the research will say is the best strategy is probably to either conclude the meeting and then come back later after you've kind of formed what you want your response to be, or to express some disappointment, just say, look, we have a lot of work to do, and I'll get back to you, right? So give yourself some time, saying, not reacting that you're going to accept any of this, but just moving forward. There was one situation I was in which I thought was really interesting. Before we even made we were in the room, we had a proposal in our briefcases. Before we made it, the target company said to us, look, no matter what you tell us, we're going to sit here stone-faced. We're not going to ask questions. We're just going to sit here stone-faced, completely poker-faced. After you're done, we're going to thank you very much. We're going to take the presentation, whether it's, we're not going to reveal what our thoughts are on it, and we'll get back to you in a couple days. And so at least we knew what to expect. It was kind of an interesting strategy. But frankly, what it did was it gave them the opportunity to build in some time and absorb what they were learning before they responded. Okay, so if we can just flip to the next slide, John, just so we can wrap up. So we've covered kind of 5 different concepts. I've tried to illustrate at least in negotiations and how important they are, right? So prepare for negotiations. Anchoring is a powerful concept that you can use to your advantage. The more generally, the more precise you can be, the more gravitas your position will have. Using objective criteria to support your position. Otherwise, you're kind of down to, just a test of wills, right? Being able to ground something in objective criteria can be really productive. And then also use what you learn during the negotiating process. So we've spent about 30, maybe 40 minutes on this topic. What I encourage you to do is here are 3 great books. The first one by Fisher and Urey, Getting to Yes, is kind of the seminal book on the style of negotiations. It's pretty interesting. Negotiation Genius by Malhotra and Bazerman, both Harvard guys, is very good. Harvard has a great center for negotiations. And then the last one is kind of my personal favorite. It's Getting More of What You Want by Maggie Neal and Thomas Lees. Which, if you had to pick one book, that would be the book that I would direct you to, and it covers all these concepts in spades. It's really excellent. Okay, so that's the presentation. How would you like to proceed, John?
Yeah. So the next step is to give a brief demo. As most of you know, when you're selling a company, it's considered a best practice, and there are very good reasons for that, to use a virtual data room, and ShareVault is a virtual data room. I'll go ahead and pick Acme Inc. So a virtual data room is a cloud-based document repository that basically very securely allows you to share documents with other parties who are doing due diligence. Very often used in M&A and partnering in all kinds of deal-making scenarios where due diligence is required. So I'm logged in now as an administrator, so basically a seller would typically be the administrator. And over on the left you can see the structure of the documents. Typically that's referred to as a due diligence list, and it's a hierarchical structure, and you have your documents organized in this hierarchy. And then what you can do is, click to view the documents, just the documents that pertain to whatever section you're clicking on. And with ShareVault, one of the nice things is that you get this little document preview before you open the document. I'm going to show how the document viewing works in a moment when I log in as an end user, in other words, when I log in as a person doing due diligence. So bear with me for a second on opening documents. In terms of tools, that you can think of your virtual data room as the best way to present the materials for your company. And it's really important to present well and to have kind of all your ducks in a row as you go into due diligence. One thing that ShareVault has that is very unique, nobody else has it, is by default when you go into all categories, by default it comes up with all categories, all documents showing, and it gives you this sort of infinite list that you can scroll through. And people doing due diligence really like that, because due diligence is a discovery process, and basically this capability allows you to scroll through the entire, I know the screen is probably not tracking this because of the fact that you're looking through this webinar program, but you can scroll through thousands and thousands of documents very quickly and get a quick overview. All other solutions require more of a hunt and peck approach, so you kind of open a single folder at a time, look at that folder, back out, look at your next folder, and it makes it very difficult to kind of get an overview quickly. You'll get there, but in due diligence, one of the most important things is to move as quickly as possible. So ShareVault is really designed, and it's well acknowledged for being a due diligence accelerator, and that's where ShareVault really shines. So speed is important. You can very easily just drag and drop to take documents and put them into the hierarchy the way you want them. I just dragged and put this document, and you'll notice that now, because I just dragged and dropped, this document has multiple tags on it. And again, that's a ShareVault unique feature. Instead of having a folder structure, a hierarchical folder structure for your due diligence list, ShareVault has a hierarchical tag structure, which means that you can put the same document in multiple locations within your due diligence list, and that's a very common scenario. With any other solution, the way that scenario is handled is by putting either dummy documents in the hierarchy that says, well, please refer to this other section, or by putting multiple copies of the same document in those multiple places, which means you have to remember to update each version, and when you look at the statistics of who's seen which document, you have to sort of mentally combine them between all the different instances of those documents. So ShareVault has a real advantage there, and that's one of the things that ShareVault customers love about our unique approach with hierarchical tagging. Before we go over and show you what the end user experience is, and by the way, you're going to want to get a more detailed demo if you're thinking of looking at ShareVault and you want to compare that to other alternatives, because you'll find that ShareVault is by far and away the best solution for this application. So we're going to do a very abbreviated tour here because we want to spend a few minutes on questions as well. But let me show you some of the capabilities around reporting. So if I go to the Reports tab, basically ShareVault has the ability to give you statistics on how many users have logged in from each of your groups. Those are the groups across the top. How many files are accessible to them, and of that number, how many have been accessed, and also the same information on a page basis. And we also track how much time each of these groups has spent. And that's really useful. This reporting information is really useful. You can also find out how much time has been spent by each group in each section of your data room, and you can drill down the user level. You can color code this so it makes it easier to find out, who's spending the most time or most effort on due diligence. That's sort of the highest activity levels are highlighted in red, and the lowest ones are highlighted in blue or white for nothing. And that just gives you kind of a quick reference. This intelligence that you get is really useful during negotiations as well.
Yeah, absolutely. Well, and obviously this takes place after you probably sign a term sheet or something, because this is more in the second stage due diligence piece. But even then, what you're looking for is how interested is the party in your company, even if you have a signed term sheet and you're working towards a definitive. And so what this information will tell you is, are they investing the time and effort to really look at the documents? Or are they just kind of lobbed in an offer and they're still trying to learn, but they're probably, they're kind of just fishing for some information? Have the lawyers really looked at the articles and bylaws and corporate minutes and things like that, which might tell you that, yes, they, in addition to everything else, that they are serious? Or have you just got some of the engineers looking at the product documents and the marketing and sales people looking at whatever you put up in those categories, which might tell you it might be a little bit more fishing rather than kind of serious interest. Anyway, I think this is a tool that can really better inform your negotiations and help you prepare for negotiations, which again is one of the best practices that we talked about.
Right, and again, this tool is typically used by the selling entity. We do occasionally have buyers use it, but since the document's actually owned by the seller during due diligence, you'll want to be administering it yourself. You also have a very detailed audit trail of exactly what's happened. So, for example, I can come in here and look at who's viewed or downloaded documents from this group called Worthington Capital, and during all time, so I can filter by time, but I'm just going to look sort of from the beginning of the due diligence, and it's going to generate this detailed report, 1,220 events, and it gives you a list of what documents have been viewed, how much time each person spent, what pages were specifically viewed during that viewing session. It's really, really powerful audit trail that, again, this is a very unique ShareVault capability. Okay, let me quickly jump over as an end user and log in as this end user Jack, same data room. I'm going to go ahead and get my two-factor authentication because protecting this with two-factor authentication. So I just received a text message to my phone. This keeps it very secure. So only people who should be in the data room are getting in. And now I can go in, agree to that's a configurable confidentiality agreement, and I go in now as an end user. These are the documents that I have access to. I also have the ability to search. Anybody has the ability to search within ShareVault. So I'm going to search for the word liability. And what's nice about ShareVault is instead of just searching within a folder for a given word, ShareVault realizes that due diligence is a discovery process. So when you do a search, it's searching everywhere within ShareVault, and then you can say, well, you were particularly interested in liability issues around financials, but you realize, you know what, I've got some tax instances of the word liability, so you might want to jump over and take a look at those as well. So you can, once you've done your search, you can kind of look for where the different documents are, and you can see that each document is shown with a context in terms of how the says. And now what we're going to do is go back to the Q&A phase. So I've seen some questions come in during the time. Some of the questions have to do with logistics, like are we going to be getting the slides? And then, there's somebody who wants to see that list of books again, so let's go ahead and put that up there. There's the list of the 3 books. There are a lot of questions about are we going to be getting the slides and the actual recording of the webinar. Yeah, you're going to be getting both. In a few days, as an attendee of this webinar, you'll be getting an email with a link to a video recording that you can go and view at your leisure. In addition, we will be posting these slides in an actual ShareVault, and you will be invited to a ShareVault to log in and download the slides if you want to. And then the other aspect to keep in mind is that for every webinar that ShareVault does, we turn it into a white paper, and it'll take us about a month to make that into a professional white paper, and that'll be available to download from ShareVault as well when that's ready. So those are kind of the logistics questions. Joseph out there asked a couple of questions about whether this is oriented towards a buyer or a seller.
So, Joseph, I apologize. I think in my enthusiasm, I probably didn't make that as clear. For the most part, it was this common scenario. If you're a startup CEO, you're a seller, and you're trying to prepare your company and yourself for negotiations with a prospective buyer. So it should be generally a sell-side view. John mentioned that I'm a mentor at StartX, the Stanford Business Accelerator, which is a tremendous amount of fun. And what I found is I get kind of the same questions from that group. Some of you might be interested in it too. So let me just talk about some of the questions I'm posed by early stage startups and sort of how I address them. One question is, when should you start thinking about an M&A exit in your corporate history? And what I tell people is probably earlier than you think, right? Now, it's hard to say when you have a product, when you're in beta, when you're in formation, but what I can tell is for most startups, if you have a successful outcome, probably 15 times out of 16, it'll be an M&A exit rather than going public, right? Because going public is a rare event. Now, you got to build your company so that it can last for the long haul and that it has runway, but you really have to realize that probably the end game, if you're successful, is going to be a sale to someone else. And in that vein, you should start to think about that, relatively early in your corporate history. Now, for instance, being able to meet larger companies, potential acquirers, trying to get on their radar from an early stage, all of that is certainly helpful, because if you get to a point you say, okay, we're now going to sell, and you don't have those relationships built, it's really hard. It becomes a really hard process.
Okay, great. And then we only have time for a couple more questions here, but this one from Dennis says, bottom line, after anchoring, do you or do you not present the selling price with supporting analysis, your position, and key non-monetary issues?
The best scenario is that's how you set the anchor, is you do it by presenting your selling, if you're the seller, by presenting your selling price with supporting analysis. And if there are key non-monetary issues to put to to put those on the table as well, so that you have a broad assortment of things that you can actually negotiate, not just kind of a single issue. So multiple points of negotiations are generally a good approach.
So just a couple more questions. Which is more important, growth or profits?
I get that from startups that I work with occasionally. Should we focus our efforts on growing the company? Is that more attractive to a buyer, or is it more attractive to really show a high profit margin? What I'll tell you is, for a smaller company, growth is much more important. Growth is, at this stage in the economic cycle at least, growth is a hugely more important factor in valuation than profits for this segment of companies. So I encourage people to really kind of focus on that. Now, that's not to say that you shouldn't be working towards getting to break even, to a break even cash flow, so that you can keep the company going and whatnot. I think that's an important goal. But trying to strive to a 10%, 15%, 20%, whatever is a natural profit margin for your company too early can really hurt your valuation if it's at the expense of growth.
Okay. And what I'm going to do is combine two questions that have come in. I'm going to blend them into one, and that'll be our last question. So the two questions are related, which is why I'm blending them. How should I make our company visible to large companies? And you should be able to comment on that, being on the buy side of large companies, in addition to your sell side experience. And then moreover, is that something we should do? And then the second question is it a good idea to hire an investment banker?
Okay, so on the first question, how do you make yourself visible? You as a small company, it's best to make yourself visible before you're ready to sell the company. And so the best cases of this that I've seen are when the smaller company actually has a way to appeal to the customers of the larger company, the prospective buyer, and they can actually work out a way to sell together, even if on a trial basis and then maybe on a small scale. Because from a seller's from what does a buyer want? What does especially a technology buyer, what does a big technology buyer want? They want growth and successful integration. And so if you can show them successful product integrations at customer sites, if you can show them where you have helped their sales force close deals, and that your products and your sales forces work well together, it is hugely compelling to prospective buyers. So that's one way. There are other ways, obviously, but for kind of traditional technology companies, that's a key way. Yeah, I'm also asked, if we're, once we get ready to sell the company, should we hire a banker? And the answer is it depends. If you have a banker that you think is really good, that will work with you for what I'll call a reasonable price and somebody you trust, then bankers are certainly additive to the process. They're additive from the perspective that it lends credibility to your desire to sell, and also gives sometimes illusion and sometimes reality that there's a prospect for other potential buyers to come into the process. And so for those two reasons, and also just because a banker by default is going to have experiences that you don't have that hopefully will be additive to how you negotiate a deal, I think bankers are generally helpful. Again, it depends on the price. Now, I've seen people get bankers who are lousy bankers who really destroy the process too. So again, I think it has to be somebody that you trust and that you know is good. Both those caveats, I think a banker is additive, and I'd recommend it in most situations.
Okay, great. Well, we've run a few minutes over, so we're going to go ahead and cap the webinar at this stage. Again, we didn't have time to get to all the questions, but they'll be included in a follow-up email to whoever asked them. And we'd like to thank you for attending this webinar, and please look forward to future M&A best practices web, 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 M&A best practices